All right, Ben, are you ready?
Yeah, absolutely.
All right, 3, 2, 1, let's do it. Hello and welcome, everyone. I'm Corey Hoffstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hoffstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
In this episode, I am joined by Benn Eifert, founder of QVR Advisors. QVR specializes in managing option-based strategies, and Ben describes what he does as volatility investing. We quickly wade into the deep end with this one. Ben schools me on relative value investing and dismisses my favored mental model of style premia for what he prefers to call the Star Wars framework. We chat about volatility ETPs, their impact on the volatility landscape, and how the market has changed since February 2018. And with some spectacular option-driven blow-ups in the last couple of years, I asked Ben for his guidance on how he would think about due diligence in this space. Finally, while Ben deals exclusively with institutions at QVR, I get his thoughts on how volatility investing might play a role for individual investors. We go deep with this one, so let's dive in. Ben, welcome to the podcast.
Corey, thanks. It's great to be here.
So Ben, I think I came across you originally on Twitter, started following you. I think you fall under, obviously, the big FinTwit banner, but certainly a specialty in volatility-related strategies, volatility products. But for the listeners who maybe haven't come across you before, could you start with a little bit of an introduction and introducing your firm, QVR?
Yeah, absolutely. So QVR stands for Quantitative Volatility Research. We're a boutique asset management firm that manages volatility strategies for large institutional investors. We've been around since early 2017. I started the firm with Scott Toyama and Tae Hong. And really, I think what we try to do is, it's a natural evolution of what I've been doing in the marketplace for a long time, but really trying to bring the skill set and toolkit of options traders and volatility managers to the space, but in a way where we can do a lot more customized and bespoke work, in the sense that I really think about the business as, we have a set of strategies that we run, that different investors have different interests and subsets of what we do. Some people want to talk about absolute return strategies in certain areas. Some people are really excited about tail risk hedging, and we're able to mix and match into bespoke mandates, rather than the older school approach, which is, hey, I have a fund and, you can get some of that if you want. It's a lot of fun. My background originally, I was a macroeconomist, emerging markets macro guy. I worked for the World Bank for a little while. Really got my start in finance full time on the Wells Fargo proprietary trading desk, which was a lot of fun back in the day. I think most people don't even remember that there was a Wells Fargo proprietary trading desk. And then after that, ended up starting and running with a partner, John Laughlin, a fund called Mariner Korea, doing relative value volatility trading under the Mariner Investment Group umbrella out in New York. And then QVR, we started in 2017 to do the same thing without a cross-country commute to New York from San Francisco, which I think is a much better situation.
Make life a little easier.
Absolutely.
Yeah. So I want to draw a bit of a line in the sand here, because I believe most of our listeners would be sort of at least aware of the big option-based strategies, right? Where you have income generation on one side. You mentioned tail risk hedging on the other. But I know you define what you do at QVR a little bit more as volatility investing and not really an option strategy. Can you maybe explain the difference between what you would consider to be more of an option strategy versus what actual volatility investing is?
Yeah, absolutely. I think, to your point, what most people think about when they think of option strategies, they think of call overwriting, for example, or cash secured put selling. or certain types of hedging activity, things that typically would have significant directional market exposure to them. So you think of, call overwriting or put writing, for example. Both of those are long equity market exposures, and on a day-to-day or month-to-month basis, really the equity market exposure is going to be the biggest risk factor, and then there will be other risk factors, second and third order beneath those. But really, market exposure is the biggest driver. I would contrast that with volatility strategies, broadly defined and broadly speaking, which really try to isolate features of the distribution of returns, but not really the direction of returns. So, for example, instead of having views on whether the S&P will go up or down, volatility investors might think about things like how volatile is the S&P 500 likely to be over the next month compared to the Russell 2000, for example. Or maybe, if the equity market goes down 2% tomorrow, where's the VIX going to be? And constructing, bets and views on aspects of the probability distribution of returns and cross-sectionally within a universe or within the same underlying in that sense. So I think that's really the key distinction. It sort of is the first order exposure to the underlying market direction or to other features of the probability distribution.
And I know in your intro, you mentioned that you guys focus somewhat heavily on relative value strategies in the volatility space. Can you explain for me what constitutes a relative value strategy? What's that sort of look like? What's the trade kind of look like that you might put on?
Yeah, absolutely. In volatility relative value, you could think of it analogously to equity market neutral strategies or to fixed income relative value investing, where what you're really trying to do is create value out of buying cheap exposures and selling expensive exposures at the same time, trying to hedge out the main directional market risks that would dominate a traditional asset allocation. So, for example, a relative value portfolio at a point in time might be long short-term volatility versus short medium-term volatility, for example. Or it might be long deep out of the money put options versus short near the money put options. So a hedged exposure that's generating some particular type of correlation. Or it might be long volatility in large cap energy companies versus short volatility in small caps.
So I'm just thinking about it from a sort of quant equity standpoint. We would say a value strategy, relative value strategy in the equity space, you would just sort of define as buy cheap, sell expensive. And you can sort of think in your mind categorically what that looks like. You gave a couple of examples there, long short-term vol, short long-term vol. Are there sort of traditional trades that you can put on that generally capture relative value within the volatility space? Or are these types of trades moving around all the time and identifying them is really an important part of the process?
I would say they move around all of the time, but over different, cycle frequencies depending on, the opportunity or exposure. So there might be some places. I gave the example of, say, for example, long volatility in large cap energy companies versus short volatility in smaller energy companies. Those type of things, typically would be an opportunity at a point in time that might show up but driven by a series of large transactions in the equity market where, for example, a large fund was doing a bunch of overwriting, in their large cap energy names, which suddenly made them very cheap, right? That might be the kind of thing that shows up from time to time, and you really have to monitor and understand what's going on and see the prices move and understand why. There are, other dislocations and other relative value opportunities that might cycle over time, but be much stickier in passing. So, we'll talk in a little bit more detail about some of the types of things that large pension funds do in the equity options market. But over the last several years, there's been a very substantial growth in index call overwriting and index cash secured put selling among pension funds trying to generate income relative to their equity portfolios. And that's, creating some certain types of opportunities that might last for several years while those strategies are popular. And then you can imagine it becoming too popular and over some number of years, then the pendulum swinging the other way. So I think there's a spectrum of the time cycle. I wouldn't say that there are many risk premia that you would expect in the space to just exist in perpetuity in a relative value sense.
That segues nicely into sort of the next area I wanted to talk about with relative value, which is, again, coming from more of the quant equity space. We would look at something and say, well, this is either a risk premium or maybe a behavioral anomaly that we're trying to exploit the misbehavior of other investors. It sounds like from a couple of the examples you gave, the opportunity and relative value in the volatility space might be sort of a structural mismatch in the needs of different market participants. How would you characterize where the opportunity is coming from for this type of strategy?
I think the really interesting thing about option markets in that regard is that they really are not a zero-sum game in the way that you might think about certain investors, trying to be smarter than the other guy in terms of whether, Apple is too cheap or Netflix is too expensive. Really, option markets, in a sense, there's a large need to provide liquidity for end users of option markets and distribute risk from where options are being heavily supplied to where they're being heavily demanded, right? So option markets and derivatives in general, the markets exist because there are end users who are trying to achieve certain objectives, right? And there's portfolio hedgers who are trying to protect their positions. There are large pension funds trying to generate income by selling options. There are, outside of equities, there are corporations trying to hedge their currency and their commodity exposures, for example, right? So these markets really developed on the back of end user demand and end user need to transfer risk. And the key thing in relative value investing and in volatility is that the marginal price setter for the probabilities and the market prices that we think about and talk about, typically that marginal price setter is not a volatility investor that's thinking about nuances in implied volatility pricing. Typically, it's an end user of options and derivatives, right? So it's a huge pension fund that's running a call overwriting program. Or maybe a retail investor buying a structured note linked to the price return of European equities, for example. These end users have their own objectives. They're typically, more structural, long-term objectives as part of a larger portfolio that aren't necessarily focused on the exact price that they're paying for an exact type of risk or a particular volatility skew parameter. They may just not focus on those things, right? So for a specialist volatility investor, many of the best opportunities really arise from either explicitly or implicitly providing liquidity to meet the needs of end users and to warehouse basis risk between what they're buying and what they're selling.
So when we were chatting beforehand, trading some emails and going back and forth, I know I mentioned to you sort of trying to get my arms around this volatility space, trying to think through things from the lens of your traditional quant type mentality of value, momentum, trend, defensive carry, that sort of mentality. And you mentioned to me that you weren't really a fan of using that mental model for the option space and the volatility space in particular, but you actually preferred something you called the Star Wars model. Would you mind maybe explaining why you don't like the sort of big sort of factor pantheon framework and why you prefer this Star Wars mental model and what it is?
Sure, absolutely. So, there are, I think, some analogs in traditional factor investing to what goes on in the equity option space. So, for example, the most obvious one is, option selling strategies for income certainly are expressions of a carry style, right? They earn a predefined rate of income if there's no move in the underlying securities. They see that income slowly eroded if the underlying's starting to move around a lot. And similarly, strategies that sell VIX futures, like XIV, for example, before it blew up in February of last year, earn carry from the typical upward sloping shape of the term structure of implied volatility, effectively generating compensation for taking the risk of loss in a volatility spike. That's a very clear analog, I think. Outside of that, I think that you see much less of the language of style premium broadly applied to volatility markets. There are some elements of momentum and mean reversion in volatility. In particular, volatility over long periods of time is and has to be mean reverting. And so there's people who think about the time dynamics of that. But over short periods of time, it may or may not be true. But on the, on the point about, the Star Wars framework, of course, that's a facetious word to some extent. But, the silly nerd analogy being that we're all quants after all, is that relative value strategies really sort of are there to bring balance to the force, right? I mean, end users of derivatives do things in big herds, and they typically have very large size relative to the absolute return community, and they're very sticky, right? So just take the example of, say, the last 5 or 6 years, when the huge pension funds of the world start to allocate a meaningful part of their portfolio to call overwriting and equity replacement via put selling. And they all do it in very similar benchmark ways in the same types of 1 month near the money S&P options in very, very big size. It creates a big disturbance in the force. It creates just this huge congestion in one small piece of the overall options market, creates really steep term structures. Market makers get stuffed with short-term options. They don't have the risk limits to hold. And the relative value community's job is really to distribute that risk much more broadly throughout the ecosystem, relieve the congestion caused by very heavy benchmarking and very, very large sizes relative to the size of the market in that particular type of trade that those end users are doing, and try to create a nice risk reward profile and get paid to provide the liquidity to that market. So really that's what we're talking about. Really, end users of options, when you see that type of behavior, tends to be very, very impactful in a particular part of the market that needs someone on the other side to warehouse the basis risk and to distribute that risk.
So when I think of the options market, my head often starts to spin a little bit. You mentioned an example of a trade, this sort of long vol in large cap energy, short vol in small energy, driven by either sort of a structural or event-driven situation where you had perhaps some sort of fund that was overwriting options on their energy book. Sounds like, in my opinion, identifying that type of trade, of all the possible trades that are out there when you consider the option landscape, could be somewhat overwhelming. And by the time you identify it, you might not be the first to identify it. You might be too early on the trade. I guess my question for you is, how do you think about identifying trades in this space? How do you think about managing trades? How do you think about exiting trades? How does the book come together? Because it seems like a very overwhelming landscape to try to get your arms around.
So we would think about the organization of our investment process. You can really think of it as a collection of bottoms-up sub-strategies or strategy sleeves. So, and an individual strategy sleeve would really be a theme that's driven by some particular type of dislocation or some particular type of underlying flow that end users are generating. And there would be, a process around that sub-strategy. So, what is the type of trade? You gave the example of or highlighted the example of the large cap energy versus small cap energy. That would be an example of a cross-sectional, relative value trade. So we would have, a definition of what is the universe of underlyings that we look at within a cross-sectional portfolio. And then in that particular strategy, because that's very much, I think the opportunity set often is more opportunistic and more fleeting, as opposed to there being structural flows that are very consistent over long periods of time. To your point, it involves building out quite a lot of infrastructure to identify those opportunities quickly, right? So to look back over time historically, map a lot of data to try to understand, how would you actually identify what looks like a good opportunity? What pieces of data are helpful in identifying and predicting that? So typically in that kind of case where I gave the example of a fund coming in and running a big overwrite sale on their long large cap equity names portfolio, for example, typically that would feed through quickly into the prices of options on that within that universe, and you'd see a significant reduction in those prices relative to the prices of the small cap energy names, for example. And you'd see also in that case, probably it wasn't driven by underlying realized volatility dynamics. It wasn't that the spread compressed because all of a sudden the names in the short basket started becoming very volatile and their prices started rising, right? And you'd have various other ways of triangulating that are very, are data driven and quantitative. And that would trigger, an investigation and potentially adding that type of a trade to the portfolio. In a strategy sleeve where the dislocations are potentially more persistent, it might be more a question of measuring how do you measure those dislocations? How do you track the ebb and flow over time? Is it a particularly attractive opportunity set? Do you want to have maximum risk on? Is it a less attractive opportunity set? Do you only want to have 30 or 40% of risk on? In terms of the identification of those type of opportunities as a starting point and the design of the strategies, really, again, a lot of the themes are very much driven by what are end users of derivatives doing in really, really big size and affecting markets. And that's not that hard of a question to answer if you're a really active market participant and you spend a lot of time talking to market makers and talking to the end users of derivatives. You see it very quickly, right? Because I gave the example of call overwriting and put underwriting among large real money asset owners being a huge theme that's driving a lot of short-term option pricing right now. If you talk to S&P option market makers in this environment the last several years, a very large part of their job is just showing up to work and figuring out how to take down the huge amount of flow that comes in that space and then get rid of it because they don't have the risk tolerance to hold it as a market maker, right? And so you can observe and see very quickly what are the things that end users are doing, and then what you have to do is think carefully about how you would leverage that and what is the mispricing, how would you leverage it to create a portfolio that has the risk reward characteristics that you want.
I've long sort of held the view that quant works really well, obviously, in a space when there's a lot of data, and that data is somewhat stationary. So non-idiosyncratic spaces, but also spaces that don't have sort of massive degrees of freedom of all the sort of directions you can play. And it strikes me that on one hand, what you're talking about do sound like opportunities that can be somewhat systematically identified, but on the other hand, some of them do seem very event-driven, which to me are therefore not necessarily easy territory to be inherently quantified by some sort of system. How do you think about the trade-off between systematic versus discretionary and volatility investing?
I mean, I very much think of it, I think similarly in terms of a spectrum between on the one hand, fully discretionary and gut feel based investing, and all the way to the other end of the spectrum of fully automated back to front systematic trading. I would say that most volatility managers, I think, lie somewhere in between on that spectrum. We are probably closer to the systematic end, maybe, a 7 or 8 out of 10 on that spectrum, say, in that we think about strategy building blocks that are developed, bottom up, using data and models wrapped together into a technology infrastructure that's continually measuring opportunity sets and wrapped together in a rigorous risk management process. But I think within options and volatility, it's really hard to get that last mile to full automation, in that, first of all, and as you alluded to this, there's just a lot of degrees of freedom, right? Even just within the S&P, there's 15,000 listed options, and there's a tremendous amount of dimensionality to the problems that you're addressing. There's also liquidity is very, very good, but the nature of liquidity in options and volatility trading is a little bit different, right? Because if you want to execute a large transaction in S&P options, typically you're not, and you want to do so very efficiently, minimizing transaction costs. Often you're effectively sourcing liquidity over large numbers of different option contracts, but synthesizing a type of exposure that you want. That's an experimentation process to some extent, as opposed to just having a model spit out, hey, buy the 2700 strangle in big size and going and doing that. Also, it's just worth mentioning, I mean, when you have a fully automated trading process, obviously a big part of what you need to do is manage that 0.001 percentile, risk case of a bug or something going wrong. And options have inherent nonlinear risk characteristics, right? So I think the potential risk of a fully systematic process is just larger in that regard. I think that's why you don't see many truly fully automated programs in the space. But I think we very much have a data-driven, process-driven approach that at the end just has a fundamental trader's risk and portfolio management judgment on top.
I really like that notion of your payoff structure is nonlinear, so model errors therefore have a very nonlinear impact, and that might not be true in more like traditional quant equity space. It's a really interesting way of thinking about it. Are there any examples that come to mind where either an opportunity was systematically identified and you had a discretionary override because the opportunity was not what it seemed, or perhaps the opposite, where you thought there was an opportunity and the systems were correct in identifying that it wasn't?
Yeah, absolutely. I'll try to give one of each historically. So one that jumps to mind on your first question, what was an opportunity that a model might have said was interesting that we stayed away from? It was a while ago at this point, but you remember back in the early days of Abenomics in Japan, back when the Nikkei was incredibly depressed, there was an interesting dynamic showing up in skew on Japanese equity indices. So skew is the relative price in an implied volatility sense of upside call options versus downside put options. And in Japan, it actually started to go positive, which is very unusual. In other words, upside call options were trading at a higher implied volatility than downside put options. And, there are some structured products that contribute to this. I'm not going to go down that rabbit hole, but a lot of folks there were folks in the volatility community that got really excited about how silly it was that an upside call option would trade at a higher implied probability than a down, or implied volatility than a downside put option, and really aggressively sold upside call options. But the key thing to remember back then was that the Japanese equity market had just been incredibly depressed for a long time, and there was a tremendous macro narrative building around big structural reforms and aggressive unconventional monetary policy driven by Shinzo Abe. And what you saw what followed that was a very volatile rally. Right. So it was really a sucker's trap to look at skew and look at a historical data set and say, oh, well, it's extremely unusual for upside calls to trade, above downside puts, and as a result, put on some type of trade that expressed that, very directly by being short the upside calls, because effectively what you were selling was the upside, the up crash scenario, which was exactly what happened. And I think as, we are not first and foremost offensive macro investors in the sense that we're not creating a portfolio based primarily on macro views, but we certainly try to be very abreast of what's going on in the world. And that, to me, was a case where the model just didn't know what was going on in the world and what the risk of that type of scenario was. So that's an example on the flip side. And then an example on the other side of things where, there was something that a model looking at historically might not have fully captured. When you think back to February 2018, so there were some things that models got really right about, Volmageddon of February 2018. For example, the VIX term structure was both very, very low and very, very flat. And, retail positioning in the VIX exchange traded products was very crowded short. And all of that data was there in the model and screaming, hey, you don't want to be short, VIX futures into this. You want to be long them and hedged with something else. But also implied volatility of volatility. So if you want to think about the VVIX, if you are used to looking at that ticker, just the price of VIX call options had gone up quite a lot. And I think a naive model that looks at historical data on VIX option prices would have concluded that it was very silly, the prices that people were paying for upside VIX call options, and you would want to be short them and then hedged with something else. But really the driver of that was just this extreme negative convexity in the marketplace associated with the size of the rebalance that the VIX ETPs, the leveraged and inverse VIX ETPs, had to do on a large vol spike. And that was a known fact out there, and people were aggressively betting on that possibility using options. And so again, very much was a type of thing where a model that only looked at historical data but didn't understand that particular dynamic would have wanted to bet on. But for us, actually, that convexity in volatility was still quite cheap, given the scenario risk of exactly what happened.
Well, I'm glad you brought up February 2018 and XIV and sort of the Volmageddon, because now I can bring it up without you rolling your eyes. I know you actually recently gave a talk at the SIBO Risk Management Conference where you spoke about sort of the different types of market participants and their response function to different environmental changes. As you look across the landscape today, and maybe take it back historically, pre-Volmageddon, how did the ETPs affect the landscape of volatility investing? How has that changed post February 2018? And who are the big players today, and what sort of effect are they having on the market?
So the VIX ETPs first started showing up. VXX was actually listed back in 2009, but it didn't become popular for a few years. Really, 2012 was really when large inflows started coming into the long VIX ETPs, which were the ones that existed at the time. So think VXX and TVIX and UVXY. And those relatively large inflows into that product at a time when VIX and VIX futures were still, relatively early stage products, had only been listed for 4 or 5 years. Those really created quite a lot of excess risk premium in VIX products. So you saw, a number of RIAs actually putting client assets into long volatility positions using these products that then lost money at a very, very rapid rate. Because there was really just way too much money effectively by all doing the same thing, buying short-term VIX futures back in 2012. You remember, and then there was an incident where the TVIX was actually suspended creation and redemption, and TVIX traded at a big basis to NAV, and it was all a big mess. After several years of losing quite a lot of money being long VIX ETPs, the general retail fast money universe started to discover that, first of all, you could short those same ETPs instead of buying them. And second of all, that there were a newer set of ETPs like XIV, for example, and like SVIXY, which rather than being long, held a short position in VIX futures. And money slowly started rotating from the long ETPs into the short style ETPs. And that position grew and grew and grew. And folks did fairly well on those exposures from 2014, 2015, 2016. And 2016 in particular was a very, very good returns year for a lot of those strategies because for various reasons, the volatility term structure got quite steep and it was pretty persistent. And then you had 2017, right, which was really a exceptional right tail event from a volatility perspective in that, realized volatility was extremely low. We had this balanced global growth, coordinated across economies, really very few surprises, nothing going on. Equity market just kind of very slowly melting up. And you saw spectacular returns in a lot of these short volatility products. And what ended up happening was both because of additional inflows into short volatility products like XIV, but also very importantly, because of retained profits on those existing investments, that short VIX ETP complex became just truly huge. And the last point's important, so I'll explain it a little bit. Typically, if you think about a balanced portfolio, you would think about, rebalancing frequencies, right? And over some quarterly or annual cycle, you might say, hey, my equities are up, 5%, so I'll sell a few of them, and my bonds are down a little bit, so I'll buy a little bit of those. But with, your typical equity investor and retail investor probably isn't as aggressive as they should be about rebalancing. And if you think about something like XIV, it's a highly leveraged product in of itself, right? So even though an investor might buy it without using any margin or explicit leverage, you would think about a share of XIV, which is effectively a full dollar notional equivalent of volatility exposure, as maybe 8 times levered to the underlying equity market, if you think of like what kind of a beta that it trades on. And, that product had, 150% return year or so in 2017. And so if you just held on to that whole position, it effectively reinvests all of your profits in more short volatility positions of this, right, at a lower and lower level. And so you ended up in this position where both due to inflows and due to performance, those positions just came extremely large. And the other important thing to understand about how a short volatility ETN behaves, right, the underlying portfolio of XIV is a set of short positions in VIX futures, right? And when volatility goes down, in order to maintain the same market value exposure that it's supposed to have, XIV as an exchange traded product has to go and sell more VIX futures, on the close. And on a day when volatility goes up, in order to have the right amount of exposure on a market value basis, something like XIV has to go buy VIX futures back, right? And if you have a mechanical response where you run a fund that has to buy volatility when vol is up and sell volatility when vol is down, that can potentially be very problematic if you're large, right? And once XIV and the other leveraged and inverse ETFs got sufficiently large, it meant that if there was really a volatility event, if something like February 5th happened, right, where the market was down, 4 or 5%, and the front month VIX future was up, 8 points, there would have to be just a tremendous amount, a significant multiple of the average daily volume of those VIX futures would have to go be bought by those products right at the end of the day, and everybody would know about it, right? So it was just a market microstructure time bomb waiting to happen. As you pointed out, the timing of that type of event happening was uncertain, but the sizes of those positions made it almost inevitable at some point. It did happen in early February. Now, really, I think retail positioning in those ETNs is much, much lighter, and if anything, biased back to the net long side. And really, the VIX complex as a whole, it's still quite large. It shrunk somewhat. Volumes are down. And a lot of the marketplace there, I think, is actually much safer and has, doesn't have obvious time bombs in it. To your question about what are the big players, really affecting markets in option land, in the current environment, I think the biggest thing that I would point to really, again, is the rise and really rapid growth of large-scale institutional real money option selling for income. So again, it's big pension funds and selling call options against their equity portfolio and replacing parts of their equity portfolio with put selling. Largely in the S&P, largely very short dated, so 1 month or thereabouts. And again, very congested in the sense that there's not really that much variation in what all these different players are doing. They're looking at, 25, 30-year historical back tests of those type of positions and doing some portfolio analysis on what type of risk allocation they should have. And the pension fund consultants are guiding a lot of big institutions on this. But I think they're not really taking into account the equilibrium effects on risk premium as the overall size of the flows doing similar things grow and grow and grow, right? And I think our view is that the expected returns in those kind of strategies are falling very, very fast and really changing gamma risk premium, sort of the expected realized volatility versus the implied volatility for short-term options.
So I want to stick with the ETPs for a second, because you mentioned something there that you thought sort of retail had shifted back to maybe a little bit of the net long. And I know that, as you mentioned, VXX, sort of the long side of buying volatility, has historically gotten a lot of sort of hate because of its decay. I don't remember where I saw this. Maybe it was an email you sent me, or maybe I saw this on Twitter, but I'm going to throw a quote of yours in your face and have you respond to it, put you in the hot seat here. But I think you said something to the effect of like, buying VXX these days isn't really that bad, and the carrying cost is a lot less than it was in the old days. And I wanted to get your thoughts there. Is this a trade people should be putting on now?
Look, I would say, first of all, everything is relative here, right? Buying volatility and hedging is pretty much always something you expect to cost you money. And I think that's generally true, should be true. There should be a risk premium there. There's also a time dimension to it. So actually, it's funny. I think I remember that quote. I think the last few weeks, call it 2-3 weeks, I probably agree a bit less with that statement than I did a month or two ago. But I think the key thing about volatility, the nice thing is, right, as a hedge, you can understand what the forward-looking cost of holding a position like long VXX is by looking at the shape of the term structure, right? Volatility can always go up or down. It can always go down, and you could lose money on a long VXX position because 1 month implied volatility goes down. But at some point, if implied volatility is 12 or something, that's not going to be your biggest risk, really. certainly not over time. But, far and away the biggest cost of owning Vega or owning a VXX, VIX futures like position really comes from the shape of the term structure, from the contango, right? Because when you buy VXX, really what you're doing, the underlying portfolio of VXX is long a portfolio of first and second month VIX futures with a weighted average maturity of a month. And so in order to do that every day, it has to buy volatility. Now think of typically the term structure of the VIX is upward sloping in contango. So typically you're having to buy some contracts out at, let's say, the 6-week point, for example, and sell some of the ones that you own at the 2-week point. That's the second and the first contract. And typically you're buying the deferred futures at a slightly higher price than the nearer term futures. And that's the way the market's way of charging you for insurance, right? You can measure how big that premium is. Typically, historically, when volatility is at relatively low levels, as it is now, you would see something like a premium of, let's think of the slope of the VIX term structure right around the 1 month point. You might think of a slope of 2 or 2.5 vol points being a typical historical level when volatility is relatively low. Up until just recently, in the last 3 weeks, we've had trouble getting the VIX term structure that steep. It's stayed, persistently somewhat flatter than that, more like maybe a vol point or a vol point and a half of steepness there, which would translate, by the way, for a VIX level around 12, maybe into a decay rate on VXX of like 8% per month or something. So I think, it really depends. You have to look at the price. You have to see the term structure. You have to understand positioning. But if we can stay in a slightly flatter term structure environment, and if we get back there, the risk reward, if you need long volatility, if you need a hedge in your portfolio, that's not a terrible risk reward. When it's 2 vol points or 2.5 vol points, like it has been closer to the last few weeks, it's less clear. That's a higher cost of carry, significantly higher cost of carry. And, there might be better alternatives elsewhere. But, if you think about through in, 2018 had a few significant volatility events. Both of them were short-lived, and the market rallied back fairly quickly and volatility fell fairly quickly. And VXX as an asset actually made some money over that period. It wasn't a huge tail event and blow up, right? And performed actually quite well as a hedge. The Sharpe ratio being long VXX was pretty good. So I think it's situational. You need to look at the cost, but I think that a lot of the truly bad perceptions of something like VXX, come from the fact that when you look at 2012, for example, right, the VIX term structure was just silly for some periods there because of the amount of huge buying of VIX futures via the long ETN. So, for example, there were times when VIX spot, where the VIX index was 15 or 16, the front month VIX future was 20, and the second month VIX future was 23 or something like that, right? So you were, in order to hold a VIX futures position, you were just losing some preposterous percentage of your money every month. I think that I don't think we're going to get back to those days. I think that that there was more of a disconnect in those days between the underlying S&P options and the VIX futures. Now that's much better arbitraged by dealers and by relative value guys. So yeah, look, I think there are times when owning VXX can absolutely make sense.
That last point you bring up about the market structure, when you see a very, very steep VIX futures curve, in your opinion, is that an expression of the market's viewpoint, or do you think that's just an expression of a market imbalance?
Typically, it's more related to risk premium than it is to some kind of unbiased forecast of future volatility. And I think that statement, I think it's true in the VIX term structure, but it's true much more broadly if you look at academic research or practitioner research and strategies. Whenever you have a term structure of forward prices, typically there are some fundamentals to that term structure and some element of expectations, but often quite a lot of element of risk premium, right? So that's the origin, for example, of FX carry type of strategies and of interest rates carry type of strategies. Within the VIX term structure, usually it reflects excess buying or selling of volatility within certain parts of the term structure. So if you think back to January of 2018, the VIX term structure was both extremely low and extraordinarily flat, given its level. And I think there, certainly among the institutional volatility and options trading community, I think there was quite a lot of excitement about the possibility of a near-term blow-up, as we saw, equity prices going parabolic in January and realized volatility actually starting to rise to fairly significant levels on the way up, and the extreme length in positioning, right? So I think that was a great example of, that really flat term structure really didn't represent the professional volatility trading's consensus view on the medium-term volatility trends. It really was a reflection of, largely of retail flow with larger and larger short positions in volatility.
So I'm going to go ahead and just change the topic a little and ask what is probably an insultingly naive question, but I always get excited to ask people who know options well. Option strategies seem to blow up a lot, man. I mean, obviously the big example, long-term capital management, is the most famous, but more recently last year, the LJM Preservation and Growth Fund, you had optionsellers.com at the end of last year. What gives? Is it just sort of the nature of an approach that has very non-linear payoffs, that sort of blow-ups are inevitable?
It's a great question. I think all of these examples that you highlighted, and I think most of the other examples one could come up with, were highly leveraged sellers of tail risk, right? So if you looked at their portfolios, LTCM, it's interesting because everybody, when you think, okay, what did LTCM really do? What was its business model? What were its strategies? People remember and like to think about, the treasury butterfly, right? The sort of 28, 29, 20 and a half, 9.5, 30-year, treasury butterfly, because the on-the-run issuance and the supply and demand imbalances and really kind of well-hedged things like that. That was where they started. They blew up because they were short absolutely massive amounts of variance swaps largely on the S&P, but also on global indices, right? And variance swaps are sort of the most negatively convex tail risk bomb that you can imagine, other than maybe like a call option on variance swaps. So the larger and larger that they got, the more returns they had to generate, a healthy return. And, they were smart folks, but those were not hedged positions. That was not kind of smart, sneaky relative value. That was just selling monstrous amount of tail risk. And that was a very large percentage of their loss, much, much bigger than their losses on like Russian debt, for example. They had, trillions of dollars of notional exposure on that type of stuff. LJM, similarly, when you look at their portfolio and you compare it to other portfolios in the option space, they had huge leveraged notional positions in short crash puts, right? They used the futures options in the S&P and the ES options specifically because they allowed a lot more leverage than S&P options, right? So again, this isn't relative value. This isn't cash secured put selling. This is just sort of monster tail risk selling with a huge amount of leverage. And then, optionsellers.com was it was funny. It was pretty sad, obviously, seeing that video. They were selling, I saw their portfolio. I mean, they were selling short-term $5 calls on natural gas with notionals much larger than the size of their accounts, right? That's just insane. Natural gas is a highly idiosyncratic, weather-dependent commodity that can spike from $2 to $4 in a week or two, right? And has many times historically. And there's many famous, blow-ups of portfolios. Brian Hunter's at Amaranth on natural gas, right? So the thing about, selling tail risk, you never really know what the right price of tail risk is, right, for some extreme event happening. And when you see firms that engage in that type of activity, typically they'll make money for several years because, it's a relatively low probability event that's going to wipe them out, right? And they make a lot of money while they do that, and they start, the natural human behavior, I think, there is to increase sizes because the volatility of the portfolio is extremely low, right? You're taking a highly negatively skewed payoff. It's going to show a great Sharpe ratio until you're bankrupt, right? And so I think, the vast majority of cases where you see option strategies that blow themselves up, really, when you dig into it, there was some massively over-leveraged tail risk type of position under the hood. And that's really what drives it.
Yeah, to your point to some of the conversation we were having earlier, where it's difficult to be systematic in a space where you don't have a lot of data, sort of by definition, tail events are low data idiosyncratic events. So it's hard to have a purely systematic approach there unless you think the market is just always overpricing tail insurance. But it sounds like, and I don't want to put words in your mouth, but if you were doing some sort of due diligence on some sort of option strategy or volatility strategy, two initial red flags, at least for you, would be leverage and are they selling tail insurance? Are there any other things? I mean, first of all, is that correct? Is that how you would at least start to look at red flags? And I guess second question would be, as people are evaluating these types of strategies, are there any other red flags that you would pick up having been in this space for so long?
Yeah, I think that's absolutely right. I mean, first of all, I would want to see and drill into, sophisticated top-down risk systems that stress all of the main risk factors in the portfolio to very extreme levels and see that the risks there were acceptable, right? There's no portfolio that, is going to make money under all circumstances and all scenarios, and that's fine. And a lot of times you know what the type of risk you're taking is, but you should always, if there's a major risk factor in the portfolio, you should be able to take that to a very extreme level that you've never seen historically and see that the portfolio is not going to be, hitting big margin calls and getting liquidated at that level, right? It should have the level of risk leverage in that sense, should be contained in a level that's acceptable to the end investor. That level may be different, right, for different folks. But I'd want to really get into detail there. I mean, I'd want to understand the assumptions they're making in those stress tests and be sure that they're not relying on overly optimistic assumptions about, how some particular hedge that they have in the portfolio performs, that it, totally saves them against, all the bad scenarios that they run. And then, in my case, very much so. And I think that, other folks doing due diligence really think similarly. I would really want to see the actual positions and hear them explain what other parts of the market, what other market participants are doing similar trades, and try to understand what the squeeze risk looks like, right? I think that if, across the alternative investments universe in general, the last, 5 or 10 years, I think that you should really think of crowded trades and crowded positions as a big source of risk, and options potentially just can magnify that in nonlinear ways, right? As we talked about. And I think that's a big risk factor if, it turns out that there's certain types of things that they're doing that everybody's doing in big size. And then I think a third point, and this can look, there's various ways that this can manifest itself, but I would want to see that they had at least contemplated thoughtfully and analytically how the strategy should be expected to perform going forward, and really a thought about, how has the market changed in the 20 or 30 years of historical data that you're looking at versus right now, not just a long-term certainly not a long-term back test or even a track record, right? Because markets in general change over time, but volatility and options markets, I think, have changed quite a lot. And if someone's not thinking about, who else is in a particular type of trade or strategy that they're doing, how much larger is positioning in that than it was, 20 years ago in their back test, for example, and how does that affect their forward-looking returns? That would be a big red flag to me.
As a firm that undergoes a decent amount of institutional due diligence, are there any questions that you receive that you sort of roll your eyes at and say, this isn't really telling you as much as you think it is? Or maybe a second part of the question, are there any questions that you think you should be asked that you are very infrequently asked?
Let's see. On the first point, sometimes people ask about things like, what's your gross notional exposure, which is a perfectly fine question. I don't think it tells you nearly as much that's interesting about a relative value options portfolio. You should really be focused on much more specific measures of risk. So, and just to give you a really simple example, right? Let's say that someone sells a $100 million notional position in, downside S&P puts, right? So that's and they're a $100 million fund, right? So that's a 100% gross exposure. And it's an option selling type of strategy. And that's fine. And you can think about, how much risk that is. Let's say that instead of selling that put, they instead sold a put spread. And so they sold a near the money put, but they bought back, a downside put to limit their risk, right? So in any state of the world with no discussion about it, that's a less risky, significantly less risky, much less tail risk strategy, much less tail risk position, but the gross notional is twice as high. And that type of problem, right? So the assessment, the right way to assess the risk of that position is to look at the scenario risk, look at, shocking the market down 10 or 20%. What's the expected performance of the position, on a one-day basis or a hold to maturity basis, for example. Look at the forecasted P&L volatility or, VAR of that type of position. Those are reasonable things to ask. It's not a good idea to, conclude that it's a riskier portfolio because it has twice as much, gross notional exposure. So I think that's, one point. In terms of what should people really ask about that they don't always ask about a whole lot, I think actually, I alluded to this earlier, but, top-down stress, comprehensive many scenario stress scenario analytics, I think are really, really important. And I think that large institutional investors always agree with that and focus on that and like to get into it, assessing the overall risk profile of a portfolio in different types of environments. I think that they should care more about, and some really do, but I think some don't enough, what some of the hidden assumptions, sussing out what some of the hidden assumptions are in those type of frameworks, because while comprehensive stress scenario analytics are really important, it's also really easy in some sense if you are, either consciously or not, to make sets of assumptions that are beneficial to the particular type of portfolio that you have, whether it's internal proprietary risk analytics or third-party risk analytics. And I think really understanding what the hidden assumptions are, trying to probe those out, and trying to look across a wide range of the types of assumptions that might be made in order to assess the sensitivity of the results. I think that that's a really good area. And again, I think there are lots of institutional investors that start to go down that road, but I just think it's particularly in options and derivatives, it's crucially important and worth focusing on.
So last couple of questions here, Ben, and I'm going to probably jump around a little bit because I know I've seen you express some interesting views again on Twitter and then in some personal back and forth. And I want to make sure I bring those out of you because I think they're really interesting points. Another really popular voice in the volatility space has been Chris Cole at Artemis, who has been very vocal for many years now, saying that almost every investor is inherently short volatility in some respect. And I know that you actually hold a somewhat slightly different and nuanced view on that subject. And I would love to hear sort of your counterpoint to his view that everyone's short vol.
Yeah, totally. No, Chris is awesome and a friend. I mean, I think that probably when we're answering or thinking about that question, we're just starting like at a different level of abstraction, thinking about a different level of detail. I mean, I think, he's really coming at it from the perspective of, risk assets are risky and everybody's long risk assets, and a lot of risk assets have embedded negative convexity. My original training in some sense in the hedge fund space was on the Wells Fargo prop desk. And on the Wells Fargo prop desk, one of the types of things that we were very involved in was capital structure arbitrage and capital structure relative value trading within corporate capital structures. So looking at, the equity and the secured debt and the unsecured debt and different tiers, within a corporate capital structure. A typical type of model, that conceptual model and, to some extent, quantitative prediction model that people would use within that space, you would think of what is there's an underlying distribution of asset returns, of returns on the business. And those different securities within the corporate capital structure really represent different types of derivative claims on the business's assets, right? So if you're long equity in that framework, you're actually long a call option on the firm's underlying assets, right? Because if the firm goes bankrupt, you're going to lose all your money. But if the firm grows and does very well and, in great excess of the cost of repaying its debt, you're the residual claimant as an equity holder and you own all of the upside, right? And so whatever that underlying distribution of asset returns looks like, the equity owners are long a call on it, whereas the various different credit holders are all short some type of put, right? So the unsecured debt holders might be the next part of the capital structure. So they have a put, with a higher strike, and then the higher, the senior secured notes are a low strike put that very likely won't be exercised against them because there's, some recovery value in the underlying assets. But if things get very, very bad, then they might lose all their money too, right? So in that framework, you think about equity owners as call option owners. And I think, sitting in Silicon Valley also, I think it's very hard to think of venture capital, for example. Venture capital is very long risk, but I think most venture capital investors really think of themselves as buying, portfolios of very, very, very deep out of the money, long-term call options. And I think they're right to think about it that way, right? They might well lose all of their money. They might well lose on 8 out of 10 bets and write them down to zero. But but they all have very wide distributions. And if one of them hits, that might pay for their whole fund, right? So Benchmark's initial investments in Uber are a good example. And I think that those trades and those positions are inherently very long convexity. That's sort of how I think about it. Now, of course, even within equities, different types of businesses have very different, return profiles, right? So you could argue that even if you want to think of equity as a call option, think of it like a utility, right? A regulated utility business. Clearly, the distribution of underlying asset values for a regulated utility are very truncated on the upside, and it's sort of all, generating a coupon, with a left tail probability of something really bad happening and the utility going out of business, right? Versus a really small, growth technology company or something. So there's plenty of nuance under the hood, but I think that there certainly are securities and assets that are long risk assets, but that are convex long risk assets and long volatility in that sense.
So I think we've pretty clearly established that the volatility space is a landscape that is very complex, both in execution and in viewpoint. But do you think that there are any option strategies that can play a role in a meaningful role for your sort of average investor who maybe is starting with the framework of a globally diversified, strategically allocated portfolio?
Yeah, I mean, historically, for your average investor, I think a small allocation to a well-managed, risk-contained option selling strategy has been a very reasonable thing as a long-risk portfolio exposure, along with their long equities and long credit and everything else that's in the portfolio. The key things there, again, are well-managed and risk-contained, so not tail risk selling. The one point I would raise, many of the more popular, and this is in some sense always the way of the world, right? But the flavors of risk-contained option selling strategies that have become popular have become too popular and too crowded, and forward-looking returns are probably a lot lower than the 30-year track record. So a good example is Iron Condor selling on an unlevered basis, which if you look at there are CBOE indices like CNDR for this, where an investor is selling a straddle or a near the money or a strangle and buying back the extreme tails so that it's, clearly well-defined risk. You're earning some carry. Typically, again, 1 month. I think that there are versions of these type of strategies that can certainly make sense and probably have legs for 5 years or 10 years. But I think it's not the most popular versions of those, which are, the 1 month S&P examples. I think unlevered, cash secured, modestly downside put selling, 30 delta puts is probably the laggard and still the best place to look in terms of, and maybe a few months out, for example, in terms of a part of the risk-contained option selling strategy spectrum that's not overly crowded, although it is starting to grow as pension funds are getting more and more involved, albeit off of a low base. In terms of more complex options and volatility strategies, I think that realistically, it's just the due diligence required to make sure it's a well risk managed strategy that is not selling tails is probably too much for the average non-specialist investor. And a lot of it, I think, comes down to just really understanding what it is that you're investing in and being able to ask, a couple of incisive questions. Okay, can you send me the risk report for what if the primary market that you're investing in, goes down 20% tomorrow? And if the answer is, well, here's why you shouldn't really worry about that, then that's just a huge red flag.
So last question, and I'm going to have to apologize because I lied to you about what my last question was going to be. I told you it was going to be the same as season 1, but this is season 2.
Nice.
So we need to change it up. So you're totally unprepared for this. And the question for you is, if I told you that you had to completely liquidate your entire investment portfolio today and only buy one thing for the rest of your life, one investment. Now, it can be a strategy, it can be an asset allocation, it could be an individual security, whatever you want, but you can only buy that one thing. What would it be and why?
Oh, that's hard, man. And it's a really good question. I mean, so really, I think, to be honest, the way that I think about the volatility and options space, I think that actually rules out almost anything in the core of what I do, because I don't think the world is static enough to have good confidence around that. I think that the world changes and good opportunities attract, follow-on money, and things get crowded and lose their attractiveness. I think that really, and it's an incredibly dissatisfying answer, I would think, but I think if I could only, make one, long-term investment for the rest of my life, it would probably be, tier 1 emerging market equities, something that effectively, represents a bet on the long-term convergence of the world, on, the increasing sophistication of the Indias and the Chinas and the Brazils, over the long cycle, to grow productivity and raise the standard of living of their populations and their workforce and all of, I think that it's an inevitable long trend and will be a very choppy path. Though I think that's, if I had to make the 60-year long-term bet, I think that's probably what it would be.
Ben, you're a good sport. I've had a lot of fun chatting with you. Thank you so much for joining me today.
Absolutely, Corey. It was a lot of fun. Thank you so much for having me.